Welcome to This Week in Money. I'm Phil Mackesy. Today, Danielle Park on a wild week in Europe, and we'll look at the week's market action as well. And David Smith looks at gold, silver, platinum, and palladium for us. We begin with Danielle Park right after this.
The best of the best. Randy Elvis Frisky and his Las Vegas show band. 40th Anniversary Aloha Tour. This April in Camrose, Edmonton, Red Deer, Drayton Valley, and Lloydminster. On sale now. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She wrote the best-selling book, Juggling Dynamite. She's online at jugglingdynamite.com. Danielle, it's always fun to have you back on This Week in Money.
Thanks, Phil. Happy spring. Happy Easter.
Oh, it is lovely. You are at the Calgary Energy and Resource Investment Conference. It's almost spring there. By the time you get there in April, April 5th, it's going to be springtime. More details at cambridgehouse.com. What are you going to be talking about this time around?
Well, first of all, it's usually a snowstorm when I fly into Calgary that week in April. Every year I come at the same time, and it's usually a snowstorm. So it would be great if it wasn't this year, but I'm not holding out any hopes for that. I'm just going to update on where we are in the deleveraging cycle, in the equity cycle, and the particular interest in that crowd is the venture and what sort of capital flows we're seeing coming into and out of various commodities and currencies and international markets.
Sounds like a lot of fun. Speaking of capital flows, Cyprus in the focus of our news today. Cypriots lining up at the banks as they're reopening, but no sign apparently of a run on deposits. I guess those withdrawal limits have a lot to do with that.
Oh, well, absolutely. I mean, the laws are quite clearly set out. You're not allowed to demand more than that, and if you do, they have whole droves of security people to show you out, right? So they have really... The reason they closed for that long period of time was to get those legislative rules in place so that no one could come in and start demanding. What I found really amazing in this whole process, watching this unfold, a couple of things, Phil. Back to my point that we frequently don't know what the next crisis, what the trigger is going to be for the next wave of the financial crisis, but we know that there's all these sort of simmering pots out there in the global economy. So the attention all of a sudden gets turned to a country who needs another infusion of capital. Well, it's not getting easy to get infusions of capital these days, not like last summer when the LTROs were in full steam and the ECB was promising to save everybody and their cousin. Now what you have is a very negative growth trend across the Eurozone, a slowing German economy, importantly, Phil, and a German election coming up this summer, which means that the politicians there are increasingly reluctant to just okay every sort of check writing to other banks, other economies, other countries. And so you see that they come up with a term there that says, wait a minute, we're not going to just give free money, especially when, Cyprus has been implicating in their own disaster here because they've been accepting all these questionable deposits from various, sketchy places around the world, money laundering operations. So they've kind of made this deal with the devil over the last few years to get some money into their banking system. And then what's happened in the last week, Phil, which is really disturbing, there's news that the Russians and various large depositors managed to get their capital out of the banks,
of course, while
they were closed to the regular population. So that is a very disturbing feature of global flows these days, where they, the oligarchs, so to speak, seem to control all the rules, control all the legislature, and are able to come and go as they please from various markets. And it's the little people who are left lining up at the door, literally looking for grocery money.
I guess a lot of folks are asking the same question. How the hell did Cyprus's banking sector grow to 8 times the size of their economy?
Yes, well, it's been a trend. I'll give you, they're not even the worst in that. There's other countries out there that are likely to be on the roster very quickly. Slovenia is one of them. Luxembourg has a banking system that is 22 times its GDP. So what's happened is that, we haven't had a global system where rules have been consistent in terms of tax policy, in terms of money laundering, in terms of what regulations banks have to undergo for capital deposits and that sort of thing. So because of that, you've had the ability of various places or risk-seeking companies and people to leave various tighter legislation areas and go to places where they're perceived to be a tax haven, as an example. So all these, quote, tax havens are going to be now in the focus of the world because, so to do the math, that everyone talks about how a banking system is actually a fractional deposit system, which means that there isn't truly the dollars that is stated on your account are not actually held in those institutions because they take in deposits and they turn around and loan out multiples of what they have in deposit. So, for example, in the Cypriot system, 84% of all the liabilities that have been underwritten by the banks were underwritten actually by the depositors. There was only 16% of actual. So, in other words, 16% of the bad debts was the maximum amount they could write down before it was haircuts to the depositors. And you see that same statistic in Greece. So as soon as, what did the LTRO do last summer, Phil? It forced all these banks to buy up bad bonds, more bad bonds, which they already had a lot of, sovereign debt of various countries, Greece, Ireland, Portugal, Spain, all these countries that were desperately trying to sell bonds. The deal was the LTRO would float liquidity into the system as long as the banks used the money or a portion thereof to buy these bad bonds. But those bonds are not worth what they paid for them. They're not worth what they're carrying them on their balance sheet at. And as soon as you have a write-down in the principal, suddenly you have a capital deficiency in the banking system. So it's an inevitability, Phil, that we're going to see more of this, and it's going to be like a domino effect from institution to institution. And capital is going to continue to scurry in front of this bus, and I think that you're going to see more repatriation to places like Germany, to places like the United States, and to some extent smaller economies like Canada. However, again, the ones that have the smallest bond markets also have the least ability to absorb international capital.
You were asking a great question on the blog this week. If the ECB can't save a country like Cyprus, which is tiny, how are they going to save countries like Spain and Italy, which are the next dominoes to fall?
Well, you talk about your fractional deposit system. They aren't going to be able to. There isn't enough money. They simply can't. Their gig all along has been to extend and pretend and to keep talking a brave face, right? So last summer, the only thing that changed in the world was Mr. Draghi's assurance that the ECB would do whatever it took, right? Meaning whatever. We had no idea of the definition, and neither did anybody else. But now we're starting to see that there is, of course, a limit to what they're prepared to do because it's not just a faceless body. The troika is actually made up of, some countries who have to write checks and some countries who are already busted and want to just get inflows. So it's quite a muck-up. It's quite a mess. And what I've seen, things like the OECD economic forecast, they had said that the Eurozone would recover in the the first half of 2013. Now they've pushed that out today to the second half of 2013. So I think we're going to be surprised for the next several months how much contagion comes into the banking system and into the currency markets in the world. And of course, it's all connected. So every time you get an exodus of capital from the euro and from the yen and from the UK pound, which you are presently, Phil, you see things like flows to the US dollar, flows to US bonds, which the yields in US bonds are back to 185 this week, Phil. So that's an inflow of money. And what happens is that corporate profits get a hit there. It's twofold. Number one, there's a translation back to US dollars for these multinationals that trade in the US, and they were the benefactor of a weakening US dollar. That was pumping up their profits. Now the opposite is happening, right? So as the dollar strengthens, they're having to translate to lower earnings for these companies. And here's another little ironic twist. We've heard a lot about corporations not wanting to repatriate capital back to the U.S. and how they've left a lot offshore in the last few years. Guess what's happening now? You want to see how a tax problem is taken care of, start losing chunks of the capital, right? So what's happening is the currency that they left the spare capital sitting in, whether it be the euro or whether it be the pound, as those currencies weaken, so too does that capital shrink. So they end up, losing even though they were trying to sidestep tax abroad.
Danielle Park is our guest here on This Week in Money. Mark Faber, Dr. Doom, gloomier than ever over at Bloomberg TV. And I love the nice contrast between Mark's pink tie and Tom Keene's blue bow tie.
Well, so here's the thing. I liked what Mark had to say in that because he was just talking from a very practical perspective about how money works and how it flows and the fact that there's no decoupling, back to this whole belief in decoupling. We just did our client letter for the month end, and there's a series of charts, and one of them is a presentation of the S&P 500, which today, which this week finally touched its prior high from 2007, revisited the high it reached in '07. The Dow, of course, has been slightly above that for the past month. What you see is when you overlay that chart of U.S. stocks versus, emerging markets versus things like copper, which is down 23% over the last 18 months, European stocks, anything to do with the venture exchange, anything to do with China. So all these other major components of the world economy are negative and have been falling for several quarters here, while the U.S. stock market has lived in this sort of world of its own. And yet the participation in that is a third of the volume you traditionally have seen over the past many years. So there's just, I call it, it's Ponzi-like in this environment, and I think Mark has a similar sentiment about it. There's a certain proportion of media conglomerates that like to keep continually pumping the idea that everybody's participating in this great bull market and why aren't you in? The reality is something completely different. The reality is there's a few people trading on huge amounts of leverage, and the bulk of the world's asset risk markets are not participating in this. And so something's got to give here. Either the rest of the world has a lot of dramatic catching up to do in quick order, or U.S. stocks are primed and pumped to the moon here, and it's not likely to last.
Danielle Park, our guest here on This Week in Money. We got some good news, bad news for Canada today. Canada's economy returning to growth in January. GDP expanding by 0.2%. But we've got a new report here, Danielle, from the OECD. They say Canada expected to lag several members of the G7 in the first quarter, and that's not good news.
Well, it's a reflection of, as we've spoken before, Phil, the increasing inventories of commodities that are now stockpiled around the world as demand has not picked up the way that people had hoped or expected. And you see us, selling less abroad at the same time that we are consuming less at home in the domestic sector because of our debt. And so, as I think we'll probably have to suffer with this low growth condition for a period longer, maybe even as long as a year from now. Our dollar has been weakening in sympathy lately with the risk off trade, which is the way it was trading in the past few years. Whenever you see a resurgence back into the risk trade, you tended to see the Canadian dollar rally. Well, that's broken down a little bit in the last while. We have not followed the S&P higher. The Canadian dollar continues to be in a downtrend. So that will ultimately be helpful for our exports. And I think there will also be another leg down here when international depositors realize that we are unlikely to raise rates. There was some rhetoric out of the Bank of Canada a while back that they may want to raise rates to sort of slow the credit bubble in Canada or the consumer debt bubble. But I think that with the growth environment deteriorating the way it is, that you're very likely to see them, remove all prospects for any tightening, probably at all during 2013, in which case you may indeed see more weakness in the Canadian dollar.
Good to see the U.S. Federal Reserve, Danielle, taking time out from money printing to publish a couple of studies here. A new one saying China's growth could slow sharply by 2030. They're saying the two big factors here, declining productivity and an aging population. You got a great feature on the blog this week about the migrants in China moving to the cities, but they can't afford to live there.
Yes, and as a client of mine who's actually lived in China was telling me this morning, it's actually even more than that. It's that many of the villages were basically consumed by the cities in the last few years as the cities were built out, but they really didn't transfer the village dwellers, if you will, to any kind of social structure or safety net that was afforded to the urban dwellers. So you have this kind of a village within cities where there's just this huge gulf between the urban dwellers who have a certain standard of living and people that actually live in the city but live like paupers or farmers, notwithstanding. And it just speaks to what an incredible misallocation of resources has gone on in the world in the last few years. And it is where, a few governments and corporations directed big money and forced certain, projects that were pet projects or deemed to be progressive or beneficial to certain recipients, but it really left the general population behind. They haven't participated. We see that in China in a very dramatic way because you've got those huge skyscrapers with no one in them and the real working people living in slum-like conditions because that's all they can afford. And so what a waste of resources of things that are just deteriorating as they stand with no utility. But on the other hand, you see that in other countries like America, where you have 48 million now on the food stamp program, and you have, no wage growth gains of any import. And that's why you see things like consumer confidence still below 70 in this month in the U.S. Here's another little thing that I think is an interesting marker. If we compare, everyone looks back and says, well, in 2000 we were in the tech bubble. Clearly valuations were crazy, especially for U.S. stocks, but for most risk markets. Then you had the credit bubble in 2007, and everyone goes, well, obviously that was crazy. That was securitization of bad debts, and everybody knows in retrospect that was an unsustainable mess. But here you are, 6 years later, with the S&P and the Dow back at the same level, Phil, that they touched in both of those peaks.
Yeah.
And yet you have an incredible divergence of the fundamentals. So back in 2007, you had GDP growth rate about 2%. You got about 1.5% in the U.S. today. You had even world GDP growth north of 4 back in 2007. Today you've got it at maybe 2.5. Chinese GDP was north of 14% growth rate. Maybe it's 7.5 today. You have a doubling of the unemployed today in America. There was just 6.7 million unemployed officially in 2007. Today you've got twice that. When you look at, never mind the Fed's balance sheet being triple the size, or the fact that back then we had an overnight rate going into the slowdown of 5.25. So the central bank in 2007 had 5.25% of monetary ability to try and step in and pump liquidity and ease. Today they're at 0.25%. So when I look at all the complacency in the stock market of the people that are invested and continue to beckon everyone else in, incredible belief that this central pumping is going to be sufficient, and you don't need real customers, and you don't need an actual growing economy, and you don't need any participation by the regular population. I think those are all erroneous concepts, and I think they will come to show that it's a very dangerous time when you buy into those beliefs.
Good news for U.S. housing prices, Danielle. Housing prices in most major metro areas in the U.S. Improved in the first quarter of 2012. But Robert Schiller, he's on the blog this week, and he's not really convinced.
Well, we did have that drop in the 10-year Treasury rates again. As I said, over the last 6 months or so, you've had 10-year Treasuries yields fall, which is where mortgage rates are priced from. So you did have lower mortgage rates in the U.S. Interestingly, Mr. Flaherty in Canada asked that the banks not follow trend, if you remember recently, Phil, because he didn't want them to cut rates again, because he didn't want more people to go out and speculate in housing. But in the U.S., there's no question there's been a resurgence of interest. A lot of it is investors who are coming in to buy properties up and then try and rent them out. We've seen some actual private equity funds focusing on that strategy and expanding the dollars that they're putting to work in that market. So you have seen kind of a burst of demand in certain areas, which has brought some jump in prices, I think 8% generally over the last year in America. But, Mr. Schiller was just pointing out that that's not necessarily permanent, or is not necessarily going to continue at this point or at that pace, because again, you have a sort of rates are as low as they can go. There's not much further benefit to anybody who tries to refinance at these levels, and you still don't have the pickup in wage growth. Average hours worked was really poor this month, Phil, in the U.S. data. So even though some of the seasonally adjusted numbers on the employment side look like they've made progress, the number of hours people are actually getting to work is not firming up, and so they're not getting these wage gains, and they've already had low rates for a long time. Another stat I thought was pretty interesting, Phil, is that the amount of U.S. household debt in 2007 was about $13.5 trillion. Today, it's about $13 trillion. So there's not been a lot of progress made in terms of getting out of debt per se for the average worker in America, and without a big pickup in gains in terms of wages or in jobs, which we haven't yet seen, and if we're heading into a slowdown again, which they won't see, it really leaves a weak consumer base. And without that participation, until we can go back and kind of bring people back into the living force, I think that the economy will continue to struggle.
Danielle Park with us here on This Week in Money. Quick look at gold. It is back down below 1,600 as the fourth quarter U.S. GDP growth is up. And the banks in Cyprus, of course, are open. That makes gold bugs feel better. But there is some bad news. Gold down almost 5% so far this year.
Well, and it's not alone, right? Copper, as I say, is below is about 340 today, which is the next key resistance, but it's down more than 1% again today, and it's been dropping. It's down 11% in the last year, and so there's just a general ongoing downtrend in metals prices, certainly in industrially used metals because of the excess supply in the world and the weak demand, but also there's this belief, which I've never held, frankly, that during times of crisis, people will go to things like gold. What you see in Cyprus, Phil, is that when there's a cash crunch, people go to liquid currency. And everyone can argue that isn't, that's not good because it's paper, it's fiat and all that, but that's how they buy their groceries.
Sure.
And that's how they actually function in their day-to-day life. They couldn't even use much credit in many of the stores in Cyprus because at some point the store owners have to have cash to go and buy their wholesale items. Their wholesalers are not accepting gold coins. They're not accepting,
Bitcoin,
or a credit card. They're accepting cash, and I think that has been the disappointment for the gold crowd because they were forecasting the credit crisis. They were forecasting bank runs. Even they must be so excited to see that is in fact what's happening, and there was a lot of reason to believe all that. As did I. I saw all that as a very likely scenario in the world, but the belief that gold will continue to get the bid when it was already bid up over the preceding 10 years on all these trends which have now come to light. So we'll see. I mean, maybe they will have people scurrying around with bags of gold and silver coins, but I really think that peak has passed.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She wrote Juggling Dynamite, an insider's wisdom on money management, markets, and wealth at last. And you can find out more at jugglingdynamite.com. Don't miss Danielle at the Calgary Energy and Resource Investment Conference. That's going to be fun, Friday, April 5th. You can get more details at cambridgehouse.com. Hey, thanks, Danielle.
Thank you, Phil. Have a good one.
The best of the best. Randy Elvis Frisky and his Las Vegas show band. 40th Anniversary Aloha Tour. This April in Camrose, Edmonton, Red Deer, Drayton Valley, and Lloydminster. On sale now. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
David Smith is a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. And it's always good to talk to him about gold and silver and what's going on in the precious metal space. David, it's great to have you back on This Week in Money.
Well, it's good to be back, Phil.
A lot of folks wondering what's going on with gold. We are bombarded on a daily basis with bad news from Cyprus and the Eurozone. Here at home, the debt ceiling, the sequester, you would think gold and silver would be going crazy, but that's not the story. Tell us why the disconnect.
Well, I'm not sure that anybody knows for sure. We all have theories, but there's so much going on out there. There's almost paralysis as much as fear. We kind of have the same thing going on here that the Cypriots do, and standing around their banks. They're not too energetic right now. They're just kind of in a state of shock. But this is what you see when markets are trying to bottom, and that's the hard part for all of us who are contrarians, is to either hang on or purchase after we've done due diligence on particular stocks or gold and silver when there's nothing out there but gloom in terms of the possibility that the bull market is even still alive.
Now, let's review the technical record here. Gold back under 1,600, as you and I were talking this morning. It lost 5% in the last quarter of 2012, down again almost 5% this year.
Yes, and the thing is, you need new buying coming in, and also it doesn't take much selling to push these things down. So it doesn't have to be a conspiracy theory or anything like this, but certainly it's in the interest of politicians to keep gold subdued, and that certainly is what's going on now. But what I find interesting is that there's actually somewhat of a shortage of American gold eagles. We're almost at a third month in a row record of American silver eagles purchased. I looked at the figures last night the U.S. Mint released, and they were just a few thousand short of what would have been a new record 3 months on. So we had a January and a February this year record purchases for that particular month year on year, and darn near did it again in March. So I find that to be kind of interesting.
Yeah.
The physical is being mopped up and sopped up, and the paper is weak.
Everybody complaining about the price being so low, yet as you point out here at the retail level, there is increased demand.
It really has. Eric Sprott, I think, has made this point as clearly as anyone. He believes that there are about 3 ounces of silver, of physical silver above ground that are available for purchase by investors in relationship to an ounce of gold.
Okay.
And so, but what we're seeing equal or exceeding dollar amounts purchased for silver in relation to gold. So here we have about, a 45 to 1 ratio right now, and it bobs around from 42 to 50 or so, and yet we're seeing the purchases of $1 gold and $1 of silver. You'd expect it to be the ratio, but that's not the case. So tremendous purchase of gold, of silver especially. Now the gold ETF, people like to point at that. There's been withdrawals there, but the silver ETFs continue to add more silver. So this disconnect is going to be worked out at some point here, probably before too long.
Now, when we read the mainstream media, David, we see all the usual reasons that gold won't be doing well. Europe's going to be okay. The S&P's at a record high. U.S. economic data, that's looking good too. All of those things are supposed to be bad for gold, and gold reacts obviously to what's going on. Do you think it's kind of coiling up, getting ready to break out, or are we going to see further weakness in gold? What do you see going forward?
Well, it's difficult to prognosticate on these things, but the charts don't look that good, and yet in another way they do. If you looked at the longer-term charts, we're still in the bull trend, and so this is the thing that we have to keep our eye on. We have to ask ourselves, do we believe that the big picture is still intact technically, which it is? We see the fundamentals, as you mentioned, all the things are supportive of stable or higher gold prices, and if you look at the mining sector where they're having difficulty with their production, keeping that up in relationship to what they've done in the years past, which, end up, production goes up about 1.5% a year. It's costing them more to do that. So these things take a while to work out, and we all get a little bit antsy. We want to see the price move yesterday. But I believe that people that have quality mining stocks and have purchased gold and silver, I think if they hold on and if they even add more under weakness, I think they're going to feel pretty good down the line. I listen to people like Doug Casey and Louis James and people like that who have been around a long time, and Rick Rule and Eric Sprott, and these are the people who say you buy into weakness. This is the time to be buying, not panicking. And so the thing is, we have to go against our emotions, and it took me a long time to be able to do that, and I can tell you it isn't easy today, but it is the way to do it, because you just can't buy when the prices are really strong and expect to make significant money.
Too easy for us to read the Wall Street Journal and listen to what's going on in the financial news and start running for the exits. If there is some kind of consensus among guys like Casey and Rule and Louis James, what are these guys saying generally that resonates with you in terms of the gold market and silver market?
They're saying that you go against the popular wisdom, both the tops and bottoms, and that's the way to add to your wealth and to limit your losses. It's very difficult to do. I think of Jim Sinclair, who's known as Mr. Gold. He was the largest futures trader around in the late 1970s. He literally called the top almost to the day on gold, literally, and it wasn't just something that after the fact he said he did. And so he's been around a long time, and he gets it right more often than he does wrong. And he really believes that this is the point in here, not to be panicking, but to be holding on and making sure that you're there for when the next leg up starts. And the same thing with Richard Russell, the doyen of letter writers. He's in his 80s, and he's still as coherent and cognizant today as he ever was. And, he's mentioned about this, all of this printing of paper money with nothing to back it around the globe. And the piper will be paid. And the people that have even a modest amount of mining stocks and gold and silver are going to be very happy that they had those positions in the reasonably near future, I believe.
Interesting analysis, David, this morning from Suki Cooper, precious metals analyst at Barclays, who says risk aversion has not risen high enough for gold to regain its sparkle. So we need more bad news. Is that what she's suggesting?
Well, here's the thing, and I think this is true more now than ever. David Morgan, when he talked about silver years ago, he said to the effect that you'd almost have to have the last physical ounce purchased before the paper price would be broken. And what's going on now, I think, is like a subterranean current, and I've used this analogy before, which I really love. You're looking at a river that's broad and deep, and it's really swift, but it doesn't look that way on the surface. It just seems to be flowing along. But underneath it, the currents are very, very powerful. And I think underneath we have this current of physical buying, not just by individuals, but also of central banks adding to their gold reserves. I mean, just a few weeks ago, it was announced that the gold reserves are being added to by central banks, the largest amount in 48 years. And we have the individuals buying quietly, and we have large investors buying quietly. One of the things that's interesting about the Silver Eagles program, and I don't have a breakout of the figures on this, but is the very large numbers of sales of what are called monster boxes, which are 500 Silver Eagles to a big green box. And those things cost, well, if you figure 500 times the current price, let's round it off to 30, it's about 28, but it's around $1,500 because there's a $2 to $3 premium per ounce on each of those silver American Eagles. Okay. So at $28, it's about $3,100 to buy one. Excuse me, it's the 5 times. Yeah, it's about $1,700 to buy one of these monster boxes. And everybody in town doesn't buy those, so those are fairly large, well-capitalized investors that are picking up on these boxes. So I look at things like that, and as opposed to listening to someone on CNN who's been a gold bear for 10 years and still is. So I'm not going to pay too much attention to that.
David Smith, our guest here on This Week in Money. Interesting to note, David, the difference between currencies here. In euro terms, gold posting a monthly gain of around 3%, best monthly performance since July. So there is an advantage to holding other currencies.
That is an excellent point, Phil. And the same thing with the Japanese yen. It made new all-time highs not too long ago in relationship to the yen. And to me, those are things to keep an eye on. And what we're seeing now, we're seeing gold stable or slightly lower in terms of the U.S. dollar. So we have to look at some of these other currencies to see. And I have to believe this contagion in Cyprus, it may seem calm now, but anybody who has paid any attention to this in Europe and even in the United States and Canada has to ask themselves, what's the longer-term effect of this? Are my accounts at risk? They actually tried to take money out of accounts that were supposedly insured, and then they later backed off and said, we'll just give people a haircut that have accounts larger than 100,000 euros. And a lot of those people apparently are going to lose 40 cents on the dollar from those accounts. But the thing is, other countries have these kind of plans in the work. New Zealand has admitted that they do in case they had to. They actually go in and take depositors' money, perhaps even if it's insured. And when Ben Bernanke in the United States was asked last week, he said, could something like this happen here? Now, this was before they had resolved it and said that they would not take money from people who had, quote, insured accounts. You know what he said? He said, it's highly unlikely. Yeah. That really makes my blood run cold.
Yeah.
Because if you ask somebody an important question and they say highly unlikely rather than yes or no, that's not really a definitive answer, but it really tells you where they're coming from and what they'll be willing to do in extremis.
David Smith, our guest here on This Week in Money. David, it's easy to get distracted by the short-term noise that we help create as well, you and I talking about this. How can we, as retail precious metals investors, get past the short-term noise, look farther out to the long-term? What should we be doing in terms of acquiring gold and silver?
I think part of it is you've set out your plan. As Pat Gorman says, you plan your work and you work your plan. And then when you make those purchases, dollar cost averaging or however you want to do it, you put those things away and you don't look at the market every 10 or 15 minutes. And this is the sort of thing that I'm going to be discussing. Actually, a week from today, I'll be at Phoenix at the Wealth Protection Conference that Linda and Pat Gorman are putting on, and I'll be talking about some of these very things in addition to a number of other speakers that'll be there. So if there is anyone listening who can get down to Phoenix or who lives in the Phoenix area, I hope they'll drop by. They will, I think, be very happy with the information that they'll be gleaning from what we'll be discussing on Friday and Saturday of this coming week.
Is there a website we can go to, David, for that?
There is. If you go to buysilvernow.com, you'll see all the information about it. And the conference costs $229 for one person. If you bring another person, it's $200 each. It's a fairly small conference, so you get a chance to really meet everybody there and the speakers on a more intimate basis. I've been to conferences and presented, and for example, in Vancouver a couple times a year. We have 10,000 people show up in 2 days. There'll just be several hundred here on this one, and so it really is an opportunity to get the individual attention and get those questions answered that you need to have answered.
We're back with David Smith. We are talking about gold and silver. We've spent some time talking about gold. Let's now focus, Dave, on the silver market. Silver has not done so far in 2013 a whole lot. It's started out around 32. It's around 28.5 or so. And a lot of folks thinking, have silver prices bottomed out? Where do we go from here with silver?
Well, there's a high likelihood that they have, because you remember they've tested several times the 26 and change area, and anything is possible. And the thing, what I would imagine, is if the price should break down through that layer, which has a lot of support, I think it could be very short-lived. It would be very scary, and it would certainly be hard to buy into it. But a real possibility would exist if that area was broken, and psychologically it would scare just about everybody. But it would be an opportunity to watch and see if you get what I call a beaker decline. So like a chemistry class beaker where you pour a liquid in, because the beaker is very narrow, it goes down and comes right up the other side very quickly in a V formation. But the thing is, I think that the sentiment on the part of market traders is more negative now, with silver being a couple dollars higher from that area than it was when it was actually down there. And I remember exactly what that sentiment was over the last couple years. So, and yet the retail investor doesn't seem to be too depressed. They seem to continue to be buying.
Are we seeing a divergence, more of a divergence than normal with gold and silver, David?
In a sense we are, but because they're both in a trading range, it's not as much of a divergence as people think. The divergence, I guess you would say, is that silver seems to be holding a little bit better on the charts than gold, but they're both hanging in there pretty good. You know, Adam Hamilton has written a lot about this, and he's shown the correlation that you find between gold and silver prices, and it's around 85 or 90%. So in other words, most of the time, 85, 90% of the time, gold and silver move in the same direction, either up or down. Not on an everyday basis, but over a time of weeks and months, there's a very strong correlation. So if we get a sustained move up in silver before too long, you're going to see gold do the same thing historically, and vice versa.
David, we were talking earlier about Gold Eagle coins and increased demand there, and also unusually strong demand for Silver Eagle coins from the U.S. Mint this year. That's got to be telling us something, right?
It really is. They came very, very close to setting a 3 consecutive month record that ended yesterday with the U.S. Mint sales of American Silver Eagles. They established a year-on-year record in January and February, and they just missed it by, I believe, a few thousand coins for this month. So that is really pretty amazing to see that continue, and in addition to ETF holdings of silver, in spite of the supposed weakness that you see in silver. So we have that paper, the war between the paper silver and the physical silver.
And we also have to remember that silver, unlike gold, has industrial uses, and I guess that helps to stabilize the price a little bit.
It really does, with new uses coming out all the time, and you're seeing a lot of manufacturers, the ones that are more astute, are actually building their own supply of silver so that they don't have just-in-time worries with that. The BMW announced not too long ago that they were doing that, and I think other companies are, without making much of a noise about it. They're making sure that they have their silver in hand that they need going into the market during times of weakness like this and buying it.
Let's talk about the mining companies. We've been talking about those all year, scratching our heads, wondering when they're going to come back.
The mining companies have just been hammered. I mean, you can pick almost anyone across the board, no matter how much improvement the management has done in terms of cost cutting. There are a number of silver companies that have announced record earnings and record production, and their share price is flat to lower. But this is what happens when sentiment takes over. It almost doesn't matter what is going on that's of positive nature. The price of the companies aren't going to reflect it. But I think what's interesting, again, looking at the roots rather than just the tree by tree, is you look underneath there and and you see that a number of these companies are actually up substantially from their lows of a few weeks ago, and they've had some very high positive volume days. And so there's buying going on in there by people that are able to go against their emotions and buy quality companies, whether it's the insiders or whether it's the average retail investor. They're both making significant purchases. And when these companies turn, they can literally turn on a dime. So if people think there's going to get a big sign that says start buying now carefully, they're going to miss it.
Now, we are tempted to do that. It's just human nature to try and get in when we think there's a huge opportunity. You've been doing this for a long, long time. Give us some advice on where we should go from here in terms of acquiring mining stocks. Should we do it all at once? Should we get in gradually? What's the best way to go here?
I really believe that what's important to do your research, and then when you decide on a particular company, let's say you don't have a position in a company that you really want to hold now. Even if you, quote, know this is the bottom, and none of us really does until retrospect, I like to go in tranches of thirds or even quarters, but now I'd say thirds. And so you would buy 1/3 of the position if the price looked good for you right now on a limit order, and you would place either a mental order or a physical one to buy a lower, what it would be 10, 20% lower, and then you would have a third order for what Doug Casey calls stupid cheap prices, which we may never get to, and yet the prices are so low now. If we did have one further washout before things really turn around, you could get a tremendous fill on a company that you really want to hold at lower prices. The nice thing about this is, and I can tell you that it wasn't that many years ago that I went all in on an idea, and then the price would drop, and I'd be depressed, and sometimes I would sell out when it would turn around. Yeah. But if you buy in tranches, you're almost rooting for lower prices. You're going against that fear complex. And so you buy a portion now, and you buy another portion if it goes lower, and a third portion if it goes still lower, after you've done your research so that you know that this is a quality company that's going to be around.
David Smith, our guest here on This Week in Money. We've spent a lot of time talking about gold and silver. We've almost forgotten to talk about two other precious metals, platinum and palladium. Platinum in the news this week, South Africa and Russia talking about having a platinum production cartel. We don't read much about what's going on with platinum. What's happening?
Well, those markets are so tiny you can't believe it. To give you an example, platinum is 30 times more rare than gold, and palladium is 15 times more rare than platinum.
Wow.
So these markets are really very small, and it doesn't take much to move them. I think the production of each is around, and this probably includes recycling, is around 8 million ounces a year. So you can see just how tiny it is, but it's very important because platinum and palladium fulfill obligations in the industrial sector that the other metals do not. And, it was over a year ago that I was writing about and speaking about on this show and others, writing articles about the PGMs, and even Johnson Matthey was very bearish at that time, and they're the authoritative source on supply and demand for the PGMs, saying that they'll probably have surpluses for several more years. And then by last fall, they were talking that we could see the biggest deficit since the early 2000s. So these metals are very fascinating, and what I really enjoy is looking at palladium. I think palladium has the same kind of a relationship to platinum that silver does to gold. In other words, we're seeing ETFs being formed in palladium. We're seeing more in industrial demand for it because it's much cheaper now than platinum. It does many of the things that platinum does, and we're seeing more investor demand. And I think that since the supply is so small and the demand is the supply is small and the ongoing supply disruptions are so problematic that I think we could see a real interesting price spike in platinum and palladium, especially of the latter, over the next 12 to 18 months. And I would see that as foreshadowing similar price rise in gold and silver for their own fundamentals.
Dave, what's the best way for us as retail investors to get involved with platinum and palladium? ETFs, I would guess.
Well, you can buy individual rounds. I believe that both that the Royal Mint produces platinum and palladium 1 ounce rounds. You can buy platinum. I believe platinum rounds are still available in the U.S. through the U.S. Mint, but they're also available through like Stillwater Mining and other labels on that. So that's a real good way to do it. They're available in bar or ingot form. The U.S. Mint used to produce a palladium coin. I think they stopped about 2008 or 9, and they're thinking about bringing it back again, and that could happen later this year or more likely next year. So those are some options merchants for having the physical metal, and they carry a premium that would be somewhat similar to what you would find in buying an ounce of gold.
David Smith is our guest. He is a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. Don't forget, David's at the Wealth Protection Conference. That's in sunny Phoenix next week, April 5th and 6th. You can get more info at buysilvernow.com. Hey, David, thanks for talking to us.
You bet. It's great speaking to you today, Phil.
Thanks to our guests, Danielle Park and David Smith. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.